Right, I want to share with you the most eye-catching stock market data of the week. As you know, I look through thousands of pieces of data, and I tend to pick about the top 10 which are worth looking at. And these are those. So let me share them with you. My name's Alpesh Patel. I'm the CEO of an asset management company. So, which are the exciting ones? The ones which made me stop, pause, think, and think, oh, right, the market's missing out on this. And when I used to do my show on Bloomberg TV, the one thing I made sure was before I went on air, I only wanted to discuss the things which I felt people didn't know that they wouldn't have got their hands on. And so let me carry on in that tradition. So here, unprofitable companies are lagging peers. And that might not come as a surprise to you, but actually, uh, it it's a bigger and bigger problem. And I don't want to be in unprofitable companies. Generally, they're the ones which, when the market falls, people leave first because they want a flight to quality. And they don't go into cash, they go into more profitable companies. And we're seeing this as the market gets more nervous. And I think it's because the market's nervous. It is moving out of unprofitable companies and more into profitable ones, because it wants that flight to quality. So for me, I'm happy about that. It means my companies, all of which are profitable, because I base it on valuation, growth, income, cash flow, are all doing fine. What else caught my eye? Well, this I thought was interesting. Price change in 2019, 2020, just in terms of some of the sectors and some of the sectors more recently from March to June of this year. Nothing sort of earth-shattering, but I think a lot of people will want to look at that. You can pause this video at any moment as well. And what were some of the companies then which had been leading, and did they follow through? Yeah, they happened to. Doesn't mean I own them. By the way, I should disclose, Mercado Libre I own, PayPal I own, Autodesk, Cadence I own. Those are the only ones of that I own. Okay. Now, this really did, again, really did sort of stop me in my tracks. The percentage of Russell 3000 growth stocks with negative earnings. These are the companies I tend to stay away from. And that's increasing. The number of companies which are loss-making, basically, the number of companies which are loss-making is increasing. Now, that's worrying, because if the stock markets keep hitting all-time highs, but on the back of loss-making companies, then there's more reason to pull back, and there's less reason to hold on to those stocks. So it's another way of depicting some of the problems we'd seen before in 2008 and 2000, and now at 2020. Those numbers, the stock market all-time highs, loss-making companies also at high percentage levels. Those two things don't sit well. In other words, move to quality companies, the ones which are profitable. That's what that tells me. And it's not just in established companies, the IPOs. Again, we're going into the number of companies which are floating on the market which are profitable, fewer. Why? Well, you could argue they're being floated sooner because the investment banks who are taking them onto the stock market know that this good time isn't going to last so long. So they're saying, look, I know you're loss making, just get the hell onto the market. And so modern IPO, and I don't tend to like IPO companies, because whenever I've got into them, it's been a lot better just to wait at least a year before getting into those kind of companies, and when you've got more listed data. So the percentage of IPOs where the company's profitable, it's been diminishing, obviously, since the 1980s, but it's certainly been diminishing, well, since 2008. And we're at pretty low levels now. What are we? We're at the lowest levels we've been at since 2000 and the stock market crash of 2000. So another little warning sign. What about this? Stocks decline. US equity benchmarks fall amid COVID variant worries and Powell's speech. Well, I thought it was quite interesting just how the Dow, the Nasdaq, and the S&P have been doing more recently. But overall, I mean, we do get these panics. We had them in September of last year, August and September of last year. Overall, it's all three indices have tended to go up, but also it tends to show the correlation of the indices. Usually they're all moving in the same direction. You could read a lot more into this. I'm not going to read a lot more into it. You can pause this and have a more detailed look. There isn't much more to read into it, but I just thought it was quite interesting what levels are, what the context is for that. So the most recent falls, well, they're not by any means the worst we've seen. Are we getting more falls? No, actually, last September, it was a lot worse than it is now, and the frequency of those falls. So again, don't read too much into the data. It's just more nice to observe. And finally, just thought I'd leave you with this. I tell you what figures really interested me here is Government debt to GDP, the United States, 128%, Japan, 266, it's been like that for ages, and they can deal with it. United Kingdom, 100%, that's pretty high. And I'm sure somebody at the Treasury thinks that US levels the UK can handle, in which case it could get 20% more debt and still have room. Uh, uh, those are the sort of major ones which caught my eye, and the French are up there. We've not had a 2008 type crisis, when we had the Greek crisis, and bond yields remain low. People aren't turning around and saying, hey, you know what, to lend money to the US, we want to charge them a higher rate of interest because we think they're a bad risk. That's not happening. So these governments, and look at the UK, these governments are able to borrow at relatively low, cheap rates. Which means, it's a bit unfair. It's like me getting a special credit card rate of 0.85% and my neighbor having to pay 11%. Guess who's going to do better? Me, especially if I've borrowed money. So what I'd say on that basis is there's more room for the UK to borrow. I mean, obviously, I'd rather it didn't, but there's more room for it to borrow. How about the US? Come on, guys. I mean, you could say, well, look, the US could go to Japan levels, could double up its debt. So it could go from what is it now, $18 trillion to another $18 trillion. And God knows, under Biden, they might do that. And it still wouldn't necessarily be worrying because it'd just still be at Japanese levels. I'm not sure that's exactly what's on the cards, but there'll be someone who has that mindset. And just imagine what you could do with $18 trillion. You could build a lot of infrastructure, could invest, could fuel growth. I think with worries about inflation, we're not going to see that happen. But like I said, those debt levels, I'm not particularly that worried about. But anyway, I just thought it's useful to have that context when so many people talk about these things. Hope you found that useful. Have a look at my campaign for $1million.com site, where you'll get a lot more information about investing, and you can download a free copy of my book as well. So that's campaign for $1million.com. And I'll try and do these each week, not least because I look through them. So I might as well inflict them on you as well. Thank you.